So I'm just going to jump right into it. Welcome to Money Buys Freedom Podcast, episode number 47. So I've seen your last name. Is it Klein or Karina?
So Karina is my middle name. So I'm glad you brought this up because we're rebranding. Klein, I used to be married and that is going to no longer be. So Ana Karina is like my first. I'm Mexican, so we always use like first and second name. So Ana Karina.
Oh, okay.
Yeah, so we're getting rid of Klein.
Okay. So I've seen you on YouTube like multiple times with Klein, and I see you on Instagram with Karina. So I was like, and
what's happening?
It's the same person. So I was like, man, either you have a twin that doesn't tax too. So I was really confused.
Yes. Ana Karina. Karina is my middle name.
So I guess just to kind of get right into it, why taxes? You just get kind of annoyed that you were paying taxes, so you want to learn all you can about taxes?
No, actually, my mom used to be an accountant. Well, when she lived in Mexico, she was an accountant. So I was like, oh, whatever, like I'll just be what my mom was. And then I went into high school and I took an accounting class and I actually loved it. So that's how I got into an accounting, taxes life. Like there was nothing else. Then I got into real estate, playing the game and all that stuff, which we can get into later, because then I realized the amount of, loopholes that there were. But I did it because of my mom.
Okay, so your family was in that field, and
correct. Okay.
Yeah. So what was your aha moment? Like, hey, I'm gonna do real estate tax.
So I was doing taxes for just like normal people at the beginning. When I opened my firm, I was just doing taxes for anyone who would trust me. Like anyone who was like, hey, I was like, great. And then obviously I was blessed that a lot of people who were a lot wealthier started coming to me, and I had attorneys who were making, over 500,000. And then I had clients who had rentals. And I'm going to be honest, at the beginning, like, you don't know what you're doing. And then I was like, wait a minute, what's happening? So when I saw the amount of taxes that the high income earners were making were paying, versus the amount of taxes that people who had real estate were paying. And I was like, something doesn't add up here. I thought I was making a mistake. I didn't know how to do tax returns. And then that's when I dove in and I was like, holy crap, real estate is where it's at. So that was really where actually seeing the numbers really made me realize how amazing real estate is, from obviously wealth building, but from the tax perspective.
So like large real estate investors are paying like little to no taxes, but they make millions and millions a year. So how exactly do they do that? Kind of just jump right into it. How exactly does real estate benefit you tax wise?
Yeah. So I always tell people, if you're a W-2 employee, you can't play the game. You are stuck with whatever the IRS tells you you're going to pay is what you're going to pay. So if you make $100,000, Uncle Sam already has that set up for you. And it's like, all right, thank you for my money. We're moving on. However, when you are in real estate or have a business, it doesn't, real estate does give you bigger deductions with depreciation. But when you have a business, you tell the IRS how much you're going to pay. So if you want to make $1 million, you're going to make sure that you deduct as much as you legally can. And then after all your expenses, you tell IRS, okay, I made $1 million, but I deducted all this. So now I'm only going to pay you on 500,000, as opposed to a W-2 employer. If you make 100K, that's it. There's nothing you can do. There's very, very little strategies for people who are a W-2 earner, which is not a bad thing. So when you get into real estate, the biggest thing, as you guys know, is depreciation. That's what drives your income all the way down.
So I think I read the book, I think it was Tax-Free Wealth by Tom Wheelwright. Mm-hmm. And he said, everyone thinks the IRS as the enemy, and trust me, I do too. But he says, stop trying to see the IRS as an enemy rather than think of them as like a partner. So the government can't do certain things. So the government has to give incentives for real estate investors, business owners to go out and do that because they can do it better than they can. So that's kind of like, I feel like a very big misconception.
Yeah, a lot of people really think that the IRS is there for the average, and I would say they're not. They're there for the wealthy, because who creates these laws? It's not your average person up there as a senator creating these laws. They're lobbyists, all of them, no matter what. If you're Republican or liberal, it doesn't matter. They're all up there lobbying for themselves, and though they say they lobby for us, there might be a little bit of truth in that. But the IRS the Internal Revenue Code is there to be played. So for example, they can't provide housing to everybody. So they rely on investors and, day-to-day people to buy properties to provide housing for these for people. And that's why they give them depreciation, all these expenses. Also, when you look at, I just made a video on this about when I used to live in Wisconsin, and when Amazon came in, and I'm sure it happens in every state, when Amazon goes into these states, they get all these tax credits because the government realizes all the amount of money that they're bringing into the state, but B, all the amount of employees that of jobs that they're generating. So that the government incentivizes people and companies to generate more money and more employment by giving them these credits and all these free money that W-2 employees don't get.
So think of it like, let's say, as a depreciation. You mentioned real estate depreciation. For someone who maybe still a W-2 employee, hasn't really gotten to real estate, what is real estate depreciation, and what do you mean by that?
Yeah, so essentially think about it like your car. So when you buy a car, it depreciates in value. So that's what happens with buildings. So essentially, when you buy a property, the IRS gives you right away, says if you buy a $100,000 property, you're going to get this freebie expense that is not a cash expense. It's just a write-off over 27 and a half years. So you literally take $100K. It's not that easy, but for this purpose, you take $100,000 and you divide it by 27 and a half. And that's what's going to give you this freebie write-off against your income. You don't get that with anything else unless it's property, like a car, or it's real property. Now, there's a thing called cost segregation, which allows you to get faster depreciation. Instead of 27 and a half years, it can be accelerated for the first 5, 10, 15 years. So you'll get a bigger write-off the first year, which is exactly how short-term rental people are doing it. Real estate investors with long-term rentals are reducing their W-2 income very, very low with depreciation.
So with the depreciation aspect, if people are trying to like calculate themselves how much of a depreciation they would have, so do they take like, hey, like look on your tax assessment, right? Let's say it has your improvement value at 100,000. Are you taking that number, or how does that cost segregation exactly work?
Yeah, I would say don't do it yourself. But if you had to, because I have a lot of people who think they can do it themselves, it's essentially if you want to do depreciation, you gotta look at your closing disclosure, which is the piece of paper where you buy your property. Take away all the expenses, take away the land, and then depreciate over 27 and a half years. If you want to do a cost segregation on your own, again, I would not recommend that, because you have to. Definitely, I would say do not try to do it on your own. But just to give a very brief explanation, it would be 100,000 minus your land, and you divide it by 27 and a half years.
Yeah. So let's say your total depreciation is $100,000. So you have $100,000 of phantom income. And I believe Trump in the last 2 years, last year it was like 100% bonus depreciation. This year is 80. So you get to depreciate 80% of it year one, basically right now. Let's say if you're making $80,000 in real estate and you get $80,000 of depreciation, you pay no taxes because they offset each other, right?
Exactly. So especially with short-term rental and the short-term rental loophole, that's exactly how it works. Let's say you make $100,000 at your W-2, you buy a short-term rental, you cost segregated, and let's say you even get let's say $300,000 in depreciation. You'll even have carry forward for future years. So depreciation is a huge, huge game changer. Just have to make sure, obviously you do tax filing, with your CPA, but that's exactly how, if you look at, I think he released his tax returns. No, not I think. He did release his tax returns a couple of months ago. And that's exactly how he ended up, I would talk about Trump, how he ended up paying really little in taxes. So he's not doing anything illegal. He's just playing the game.
Yeah. And what I did know, for let's say for a W-2 employees, and they wanted to do write their short-term rental depreciation off, what do they have to do? They have to keep meet material participation and stuff like that, right?
Yeah, so I'm going to make this as easy as possible for people to understand, because it's a complicated thing. But essentially, if you're a W-2 earner, let's just say you're a single person and you work at Chase and you make $200,000 and you want to go buy rentals. And you buy rentals, and then you hear me and you talk about depreciation, so they think they're going to go into their tax preparer and they're going to not pay taxes. Unfortunately, there is a little law that says if you make over $150,000, so if your modified adjusted gross income is over $150,000, you will not be able to take any losses from your rentals. So easy calculation, you make 200,000 at Chase, you buy a rental property that has a loss of 10,000, it will not offset your W-2 income because you do not qualify for real estate professional status. And so we'll go into what that means. So what a lot of people do is they buy the short-term rental because there is a loophole. So in order to be able to take the losses against your W-2 income, like I said, you have to qualify for real estate professional. What does that mean? That means you have to pass these two tests. Test number one is you have to work more than one half of your time in a real estate trader business. In other words, you're working at Chase, for which a full-time job is 2,040 hours, 2,010 something, let's say 2,000 hours. In order to qualify for the first test, you have to prove that you work 2,001 hours, so 1.5 times in real estate. Impossible. You never sleep. Like, it's not going to happen. So if you work at Chase and you have one long-term rental, you're not going to qualify. The second test is that you have to materially participate, meaning you have to be the landlord of your property. If you already failed test number one, obviously you're not going to make test number two. Where the loophole comes in is if you own a short-term rental. So let's go back to the example of the person who works at Chase making 200,000, buys a short-term rental and materially participates. It means that they work a minimum of 100 hours more than anyone else. They do the landlord stuff. They are on Airbnb. They're, doing all that stuff. They keep a time log. Now that loss can go against their W-2. So it's complicated, but it can be done.
Oh, okay. So you just pretty much got to keep really good time logs. Like, you got to pretty much, like, let's say you're running it as a business, you keep like, hey, this is when I used this is when I did this, kind of keep very good books so you can, because I always heard the IRS is like you're guilty till proven innocent. So it's like you got to be able to prove that you actually did it.
So exactly. So with the IRS, you are guilty until proven innocent, not like the criminal justice system. And honestly, the best case scenario is when you are married and one of them has a W-2 job and one of them qualifies for real estate. That's like the golden ticket. I mean, don't go get married just for that. But if you're married, one of you should qualify for real estate professional.
Okay. So I think I remember seeing it on your page. You were talking about the Augusta Rule. So my understanding of the Augusta Rule is it would be very hard for you to, let's say if you're a real estate agent, rent out your home to for like a client event or something like that, because I don't know. I just always heard it's very hard to be able to do that for an Augusta Rule.
So no, I think as long as you have proof, I mean, you're running a business and if maybe you are holding events for a real estate investment or you're holding your board meeting events, that's why it's really important to have LLC documents, because your LLC documents will tell you who's on your board of directors, what you're going to talk about. So you could do the Augusta Rule for any business you have, as long as there's, it's legitimate. So I don't think it's hard. I think it just has to be documented.
So what if you didn't have an LLC though? Let's say you're just like
then it's a little bit harder. Yeah.
Okay.
That's why it's good to have an LLC with organizational documents that you don't create on your own on LegalZoom, that you actually use an attorney. But I can rant about that all day.
So tax season is about to come up. Everyone has a big fear of, we're going to pay a lot of taxes. Maybe they think they're going to get money back. What's the best questions they should be asking their tax professional to get ready to file their taxes?
Yes. So it's going to depend. If you are a W-2 earner with no real estate or anything like that, I would definitely suggest doing your taxes on your own on TurboTax or H&R Block Online. Those will suffice. They're pretty easy. They really literally walk you through everything you need. However, if you have a business, any type of business or real estate, what you should need to be doing is having really good records, really good financial statements. Unfortunately, there's not a lot that can be done right now for what happened last year. So what I would suggest is, find an accountant in your niche. So if you're a manufacturer, okay, make sure you find someone in manufacturing. If you are in real estate, make sure you find someone in real estate.
Yeah.
Don't just go with, I get this all the time. We're like, oh, my parents' accountant who's like 80 years old. And I'm like, there's nothing wrong with that. However, if they don't know anything about the niche that you're in, they're not going to help you. And really the biggest thing is making sure that you do tax planning, which should be done throughout the year. So there's a difference between tax prep and tax planning.
I'm glad you said that, because Everything I've heard the tax system is so massive. It's hard for like a real estate professional to know everything. So that's why like most real estate professional or real estate tax professionals, they specialize in that specific thing because there's so much.
Yeah, there's just so much. I mean, especially in the last couple of years, things changed during COVID. Like there was no tomorrow. One day you got free money, the next day you only got free money if you did X, and then they canceled that. It's like, I think one of the things I love to get out to people is like, we're not magicians and we're still humans. And people just expect like, whoa, how come my CPA doesn't know that? And it's like, Karen, things change every day. Like, relax. Like, I need to figure out what's going on. Like, it's not gonna happen. And there's nobody you can call. And like, people really think we can call the IRS and be like, hey, so I have a question. They'd be like, okay, well, we can't help you because it's just normal people who are working there. You know, they don't hire they don't hire CPAs who are extremely knowledgeable. They hire people who need a job and get paid not good enough money. So patience, people.
I got you. Hey, so even on the internet right now, this is a big thing about the consumption tax. I mean, I kind of understand it a little bit. How would you explain that to someone, and what is that? Because they talked about like getting rid of the entire IRS.
That's not gonna happen. So essentially, what they want to do is just cancel all taxes. Well, not all taxes. The way our tax system is working right now, and essentially would just be it would be like a sales tax on everything that you do. However, I was reading in it too that businesses it would be impossible to. Here's the thing. Yeah, so they want to change it and they want to just charge on sales and use. So every time you use something, every time you sell something, you would pay taxes on it. Here's the thing. They can't even answer a telephone at the IRS. So how are they going to I'm not even worried about the tax law. I'm worried about the amount of labor that goes behind it to report sales and use tax. Because if anyone has an Airbnb here, you do realize all the tax that goes into it. You have to report all that. So I'm like, where are they going to hire all these people with what kind of money? What infrastructure are they going to have? I don't think they'll ever do that. But funny enough, it was a Republican who was like, came up with this. Yeah. So, I don't know. People just remember when, well, I think it was like Trump who was like, we're going to make taxes on a postcard. And it's like.
Make taxes on what?
On a postcard. Like if it was supposed to be that easy a couple of years ago, it was that. It was like taxes are too complicated. You're going to be able to file them on a postcard. And it's like, it's not going to happen. Like, so until they change it. Go ahead, sorry.
No, so at least I'm going to just touch on this a little because I'm a little confused. So even when like my understanding of like what I know about money and taxes, even when like I feel like people just want to like, hey, why not tax the rich, tax the rich? And they always talk about, hey, we're not going to tax anyone over 400,000. My understanding is like that doesn't do anything because all that does is tax like lawyers, doctors. I mean, people like that. That doesn't really affect Bezos, Elon Musk, these people that are mad at.
I'm so glad you brought that. I'm so glad you brought that because we're like, oh, it's not going to affect only people who make 400,000, and it's like. Well, I feel like if you look at the population, the amount of people who make, over is the 1%, right? But at that point, you make so much money that you're like, I don't really care that it's increasing it because here's what's going to happen. If you make, let's say, $500,000 as a business owner, you're going to do whatever it takes to decrease that as much as possible. So you're going to go buy that private jet, that Grant Cardone bought, that Kim Kardashian bought. Like, you're going to write everything off. I think what people don't understand is that it's the tax code is not for the average day-to-day, unfortunately. That's just my opinion, right? Everyone might have something else. It's really made for people who have money. As much as they want to tell you that, oh, here's a credit. I mean, that stimulus credit of $1,200, don't get me wrong, that was nothing. I mean, what did that get you through COVID? $1,200? Okay, cool. That didn't really make a difference, right? And it's sad because it's like if they made the tax code a little bit better, that actually helped the day-to-day W-2 earners, we wouldn't have to print out money and give $1,200. So I feel like that's honestly, I could talk about that. Like, I think what people need to realize is that they need to be educated and start a side business and a side hustle so they can take advantage of all the tax code.
Well, the government, in my opinion, doesn't trust us to pay our taxes because let's say as a W-2 employee, you pay your taxes first and then you pay your expenses. A business owner pays their expenses and then pays what's left over the taxes. And that's the biggest thing is like, for me, like let's say you make 100,000, you're getting taxed that right now. Then you got to go live. A business owner makes 100,000. They may only get taxed on like 20.
34, exactly. And that's what the tax code allows you. So it's like when people who have W-2, I understand their frustration because how is it that $100,000 person does not pay the same, who's a W-2 earner is paying more than $100,000 who is in business, right? So it's really the stuff that they don't teach us in school, and it's all about education, about being educated, about realizing that the W-2 life is great. I'm not saying, I don't care what you do, but if you're mad about taxes, it's because you have to be educated, that you need a side business or real estate in order to play the game. Otherwise, they're still going to take your Social Security, and you better hope that by the time we retire, that money is going to be there.
At 90 when they push back the retirement age.
Exactly. It's like, so I'm not trying to give money away for free. And I do understand that there are a lot of great programs that the government does do for people who need them. Coming from a third world from Mexico, which can be a third world country, to be honest, they didn't give crap there. Okay. During COVID, they're like, sorry, you're poor, and you're still poor now. So there are great advantages that the Internal Revenue Code gives to people, with children, being able to take the credits they give for daycare, but it's not for everybody. As soon as you make like 100K, you're like, oh, you're rich now. And it's like, well, 100K doesn't really get you anywhere nowadays. It's like,
100K is the new 50K. Because everything's up, everything's expensive.
Exactly. But I did not know that the percentage of people who make six figures is really, really small.
Yeah, it's real
and
small.
I had no idea. And I was like, that's, we got to change that somehow.
I think it might be 1%. I think. I don't know.
I think it's very, very small. Yeah, I don't want to quote because some people will come trolling me like, what are you talking about? But it's like
they'll clip this one little section. Oh, she said this.
Yeah, which I don't care. I'm like, let them talk. All publicity is good publicity.
Yeah, right. So let's get into self-employment. Self-employment tax is a little different. They have to split their FICA taxes with their. Like, how usually W-2, you split your FICA tax with your employer. W-2, or not W-2, self-employed gets paid tax more. Correct?
So essentially the way that it works, think about it when you're a W-2 employee, the self-employment tax, which is 15.3%. So where you're a Chase, you pay half of that, Chase pays half of that. But when you become self-employed, there is no Chase. It's Anna and Anna. So at the end of the day, you end up paying the same amount. It just comes out of the same pocket. So it is the same thing, but you pay the entire thing as opposed to Chase paying half of it.
Yeah, I gotcha. Makes sense. Yeah, so for instance, for the LLCs, let's say you get your LLCs, people can do like a sole proprietor, S corp, C corp. When should you do what? Let's say you're like a real estate agent, right? And you make a certain amount, you should do S corp. A certain amount, you should do maybe C corp if you have multiple. Like what's the stages?
Yeah, that the answer is always depends. But here's what I'll say: it depends because it depends what state you live in. Like people who live in California, New York, it's always like slow down. California is going to take a lot of money. So here's the rule of thumb that I tell people: when you start a business, depending on what state you're in, get your LLC. It's in Wisconsin. It costs $26 to get an LLC. But talk to someone before you do it on your own, because obviously when you live in states like, and I'm giving you all this because it is complicated, in Texas, as soon as you have an LLC, you are tax franchise tax. So it all depends where you live. So the biggest thing is making sure you keep track of how much money you're making. So let's say you start your business in February and then by April, you're already netting $100,000. We should probably make you an S corp. An S corp will minimize your self-employment tax, which is that 15.3% we were talking about. But it's going to be hard for me to say, hey, Joe, let's do an S corp. We're going to charge you $2,500 for the tax return, but you don't even know how much money you make. So is it worth the $2,500? So it's like having good bookkeeping and knowing your numbers is going to make or break and really make you the difference between how much money you're going to pay in taxes or not. So I always tell people, find a good CPA, but regardless if you have the best CPA, if you don't have numbers, it's not going to help you.
Yeah, let's say they keep good books, and let's say their biggest question is they don't know what they can and can't write off for the business.
Oh, that's a great question.
So what would be some, like, even the questions you get asked all the time that people think they can't write off, but they can write off?
So there isn't a list that the IRS gives like, hey, here's a list that things you can write off, right? It really depends. So the answer is, as long as it's an ordinary and necessary expense, you can write it off. Here's examples of things that you can write off, and here's examples that you're like, okay, what the heck? So let's say you're a real estate investor or a realtor or a TikTok influencer, whatever side business you have, and you need to fly out to Florida to an event. Okay, now that travel is a write-off. You want to fly first class? That's a write-off. So there isn't the IRS telling you, oh, you can only fly coach and you can only stay at a Motel 8. Like, you can do whatever you want when you travel, as long as there was a need for you to be in Florida for that event, right? What you're not going to do is you're not going to be living in California. I have this, all my California people do this. They live in California and for some reason, and then they have rentals in Tennessee. And they're like, well, Joey told me that he bought a Ferrari and deducted. And I'm like, you have rentals in Tennessee? Why are you deducting a Ferrari in California? No reason. However, if they were smart and they played the game right, if they started a YouTube channel and the Ferrari was like a part of like clickbait, there are ways to deduct those big, amazing cars. But just because you have a rental in Tennessee doesn't mean you can. So there isn't a list of things that you can deduct. It's always make it a write-off. That's why I tell clients, figure out how to make that a write-off.
Okay. And just for anyone listening on Instagram, if my phone dies, we're live on Money Buys Freedom podcast on YouTube. So if we die on Instagram, just check us out on there. And so get back into the expenses. I always heard that you have to be able to prove it. Let's say you have to predestine it, like predetermine. Let's say, like, if I'm going to go, like, not just like go ahead and fly to California, like, oh, there's an event right here, I'm going to write this whole trip off. How do you, plan to protect yourself from the enemy?
I really think it's just making sure that you plan accordingly. I mean, if for some reason you should try to make everything a write-off. So yeah, you're not going to show up to California because you decide to take your kids to Disney World and want to deduct that, and you found some guy on the side saying he's a real estate investor. So I always just don't be greedy, because that's where things happen.
Yeah.
Now you see all these people deducting their private jets, and it's like, that's legal, but you just have to be really good about, does it really make sense? Like, a guy making 100K is not going to go buy that Ferrari because he decided that he could do it, So it's like, It just has to make sense. Don't get greedy, because I'm telling you, the IRS will find you. They can't answer the phone. Trust me, it takes hours, but eventually they will come and find you no matter what. I mean, you've seen the cases of people who think they can outsmart the IRS, and they can't.
So let's say there's like a mastermind. I think Bigger Pockets is into this year in Miami. Let's say someone wants to go to the Miami BP Con. Let's say they want to go to Miami, and they want to do all this other things in Miami. Let's say if they predetermine by their hotel and all that stuff, can they write off everything they do in Miami, or just where they go, that specific?
So there's like a sandwich approach. So essentially what you want to do is you want to make sure that at least, I think it's 80% of the trip is business. And then if you decide to stay an extra day, the travel back in the hotel there or a couple of days more will be an expense. So I always tell people that that's why all these people like Bigger Pockets, Mark Kohler, they have all these events in cool places. They go to Hawaii. I don't know why someone hasn't done one like in Europe, because that would be great. But it's like Hawaii, Puerto Rico, Miami.
Yeah.
Like, Europe would be great. I'd write that $10,000 off. So it can be done, and that's why they do it.
Maybe that's your first tax event is in Europe.
That would be so fun, actually.
But so even with food, let's say, because I know this year is different than last year. This year you can only write off 50% of your food. Is that the same thing if you go to like Miami and you're going to a conference? You can only write off 50% of that, or is that different?
No, so food is 50% anywhere you are, so it doesn't matter, unfortunately.
And you can you write off yourself, or you have to write off like everyone on the table?
You can write yourself only if you are an event. But the way that food write-offs work, a lot of people think that they're like, oh, well, let's take, for example, like a guy who runs an HVAC system, HVAC company, right? Obviously, they're driving around all day. Your lunch is not a write-off. Just because you decided to stop at McDonald's on your way to your second job does not mean that's a write-off, because the government's like, well, you should have packed your lunch. Whether you did or not, that's not my problem, right? But that's not a necessary expense. However, if your route is here in Dallas, but now you're going to Houston, that's out of your route, so you can write that off, whether you're by yourself or with somebody else. So back to the question is, always go to lunch with someone about real estate, about the HVAC, about short-term rentals. I mean, I try to make all my dinners, invite my friends who are in real estate. So like, that's why you got to be with friends who are in the same circle, because then that's a write-off, because you do talk about, it's impossible not to talk about business.
Yeah. So how specific do you have to write down, like, hey, I met Ana Karina at this the time, talked about tax, told me I was doing it wrong.
Yeah, definitely want to be as detailed as possible. So what I tell people all the time is, on your receipt, write who you were with and kind of just a brief description of taxes 2022. That's what I would write, and that should suffice. Okay.
So what other typical expenses for like even real estate business owners that you can write off? You got food. Can't you give your kids like you can pay your kids a certain amount? Like let's say if they work.
Paying the kids strategy is great. If they're under 17 years old, you can pay them up to, I think the standard deduction this year is almost $13,000. So you can pay them up to $13,000 without filing a W-2 for them. Once they're over 17, you have to do payroll. But yeah, that's a write-off. So what a lot of clients do is they pay their kids. Well, they pay their kids, but the money that's in their bank for the kids, they take it for themselves. And they essentially took a write-off on the business, move the money to them personally and the kids, and they do whatever they want with it. So there's so many, like the kid strategy is great. There's a lot of compliance behind it. But if you have kids and you have them work in the business, you should be taking a write-off.
So if you have like, I have a 2-year-old daughter. I mean, what is she going to do? So it's like, hey, she just smiles in the photo. She's like, peace.
Yeah, no, I have some client. Listen, people push the envelope. Your 2-year-old doesn't do anything for your business. I'm sorry to say that, unless you had a YouTube type of client who has YouTube, right? And her child is always in YouTube because she's a mom. That's different. But when you own one short-term rental and you think your kid on the picture is a write-off, I mean, if they come out of you, I just don't know if I can say that your kid's the cutest kid in the world, and that's making the difference.
Yeah, I gotcha. So, you kind of have to like prove they do something.
Yeah, a 2-year-old doesn't, but a 7-year-old can help you do some things around, the office.
Yeah. So if I made a YouTube video, just grab my 2-year-old a little hammer and just make her running around.
There you go. I mean, you got to work. I always tell people, figure it out. Start your YouTube channel. Be like, I'm making my kid be here,
Yeah, I got you. So does that kid pay, or your kid, whatever, pay that $12,000 like taxes, or is that completely tax-free?
So that's why you have to do it up to the standard deduction every year. So I think the standard deduction this year is like $12,950. So you pay them $12,950. They are not required to file a tax return. So it's essentially moving money from one place to another. Also deduction. Yeah, it's a great strategy. When they're 17 and older, it's a lot different. But by then you can put the money in an IRA, and then they don't end up paying any taxes. So
one thing I made a mistake on my taxes a long time ago. We fixed it just in case the IRS is listening. So when let's say I had a rental property and my mortgage, I made the mistake of writing off the entire amount instead of just the interest. Can you kind of explain that and why they do that?
A lot of people do that. So you have to remember, when you have a business and you are using a home office, or actually, let's go back to your question. Only the interest that you pay on your mortgage loan is deductible. So if your payment's $10,000 a month, some of that goes to principal, some of that goes to interest. So when you deduct it, you only get to deduct the interest. We're really careful with our clients because we see that all the time. I'll see someone, I'm like, you paid what, $70,000 in interest. I'm like, unless your house is like a couple mil, like it's not happening. They're like, oh no, yeah, it's the full payment. I'm like, no, only the interest.
Yeah, it's depressing, but you still got depreciation to kind of help you out too. So it's not that bad.
Exactly. I can't have it all.
So what about, like, you can write off gas to and from places, and is that, can you even do that even if you have a property manager and stuff like that, or?
Yeah, if you use your car to drive around, you can definitely deduct the gas, the mileage, either one or two. With cars, there's two ways to deduct it. If you buy the car, you can take depreciation, which that's where the 80% bonus depreciation comes into play, meaning you can write off gas, insurance, the interest that you pay on the car, repairs and maintenance, car washes, that's that. However, if you think that you're driving a lot and really far, mileage might be better for you. So you have to choose between one or the two, either actual expenses or mileage. Yeah. If you lease the car, you only get mileage or actual expenses, but there is no depreciation in leasing because you do not own the car.
Oh, gotcha. But so even like, let's say you're a real estate investor, and let's say you have it all in your name, you haven't built any LLCs or anything like that. Let's say, I always heard there's a tax loophole for your business, if the car weighs over 6,000 pounds, you can write off the full car.
Yes, as of 1/1/2023, it'll be only 80%. So if you buy a car for your business, if you buy a car for your business and it's over 6,000 pounds, you will be able to write off 80% of it. So if you buy a $100,000 car, you'll get literally an $80,000 write-off. Last year, though, everybody was out there buying. I mean, including myself. I bought myself a car because I was like,
buy Tesla?
Heck, I hate Teslas. If you know anything about me, I hate Teslas.
I just knew they're over the weight limit, and there's not many cars that are over the weight limit.
It is a real estate world. All my real estate friends have Teslas. I like cars that make noises. I want to show up and be like, hey, I have a car. I'm not just sitting here. So I love cars, so it's different. But yeah, Teslas are over 6,000 pounds.
I got you. So let's say, for instance, most people are afraid not really afraid, but let's say they're selling their properties. And I always heard, like, let's say I lived in a house for a certain amount of time, and I move after that 2 years. Do I have like a 3-year span of before, like even if I rent it out, that I can do it tax free? Or as soon as I change it from a personal residence to a rental property, you're already getting taxed in? Because I've heard it both ways, but I'm not really sure which one to.
So let's talk about the two options. So let's say you personally never rented the house. So you and your spouse live in a house for 2 years, and you make a gain on that. You know, obviously last year was crazy, so people were selling their houses and making a lot. So if you live in the house for 2 years and you make a gain of, let's say, up to $500,000, if you're married, you will not have to pay taxes on that, as long as you live in the house for 2 out of the last 5 years. Now, let's say you're like, I'm going to move, but I want to make this now a rental. A portion of that, if you decide to sell it, as long as you lived in it 2 out of the last 5 years. So let's say you lived in it 2 years, then you rented it for 2 years, and then you want to sell it. If you make a gain, some of it will be the part of the exclusion that we just talked about for personal. So let's say you make $500,000. Some of it will be part of that exclusion, but there will be some part that you will be taxed on for a capital gain, since it's an investment property.
Ah, dang it.
Yeah.
So as soon as you move it over, you're getting taxed. I got you.
Yeah.
Interesting. Yeah, because I've heard it both ways. That's interesting.
But they can too. I have one of my friends, and maybe I'll look into it more. I have heard that as long as you live in it for 2 or less 5 years, and let's say you live in it 2 and you rent it 2 and then you sell it, that it all qualifies under the exemption. That's what you've heard, right?
Yeah, I've heard both ways. So I've heard it was the person who was saying the rental property wasn't specialized in real estate, so I wasn't sure if it's a little different. So I wasn't sure. I've heard that. I'm not even sure. I can't remember who told me, but it was like, say for instance, back a couple of years ago, I had a rental property, lived in it for a couple of years. We were on the fence, like, hey, do I sell it now, or I wait and rent it out for 3 years, determine, because I always heard, like what you said earlier, 2 of the last 5 years, and then sell it after that ways and do that. But I end up hitting that 3-year mark, and I was like, I'm just going to keep it as a rental anyway. But if I would have done it, I was curious if would have been tax free, or like what you just said, like, oh, only a portion gets tax free and the other one is that.
I've heard both too. I stick with mine, but yes, I've heard both too as well.
It makes sense because you're kind of moving it as a business, not necessarily a primary residence. So that makes sense.
Yeah, exactly.
So if the house stayed vacant for 2 years, that's the only way you could get tax free.
Yeah, exactly, because it'd still be your personal, like you still qualified and you lived in it 2 out of the last 5 years.
Or like your kids lived in it or something.
Mm-hmm. Yeah.
I got you. So let's talk about how they can avoid taxes if they sell. And let's say they're selling a rental property. I always heard there's 2 different ways you could do it. You could either you can sell it, take that gains, buy another one and cost segregate it, or you can do a 1031 exchange. So can we talk about both of those?
Yeah, I think what you mean is, so the first one, it would be a 1031 exchange. So you buy a rental property and then you want to sell it and you take all the proceeds and invest in something the same, whether it's larger. So you can go from a single family to a 10 unit or the other way around. And as long as you invest the proceeds from that into that, you will never have to pay taxes. Well, you never say never. You're just like throwing the can down the road to pay the taxes. That's the only way that you can actually avoid paying taxes. The other way would be if you do seller finance. Seller finance just essentially gives you more years to pay the taxes. So if you seller finance it, you're not going to pay you're not going to get all the cash right now. So you'll pay, if you were supposed to owe 100K, you might, divide that 100,000 into 5 years, depending on how many years you decide to seller finance it.
I got you. So let's say the house is worth $200,000. And they want to seller finance it just like a mortgage, and the other person buys it seller finance. And let's say the interest is that. How do they pay taxes on that seller finance deal? How does that work?
So let's say I'm selling you my house for 200,000, and you are only going to pay me 20,000 now. I would only pay on that portion of the 20K. We have to do the calculation of the gain, but that would be my tax. However, you have to pay depreciation recapture. So anything you've depreciated, we pay the year of. So if your gain is 100,000, it's complicated. You would, whatever you pay me the first year is what I would pay taxes on top of depreciation recapture. Yeah. But if the remainder would be paid over the taxes would be paid over the next 5 years, if that's what our loan is.
Oh, gotcha. Because I had this scenario. I kind of will touch on it. So the parents let the kids live in it for a certain amount of years. It was never a rental property or anything like that. And they want one of the kids wants to buy it for seller finance, and that, let's say it's at 200,000. Let's say they do a mortgage with the parents for 200,000 at 4% over 30 years. Do they pay? I guess they pay that down payment they gave them, and do they pay like per month just the interest, or how does that work?
Yeah, so the people who are selling it, so the parents would pay taxes on any depreciation that they've taken the year that they sell it. But let's say if they were going to pay 20,000, and your gain, whatever your gain is, will be divided by the number of years that contract is for. So if the gain is 100,000, that would be divided. They wouldn't pay $100,000 gain the first year. It would be divided by the number of years that they have the contract for. But the depreciation recapture would be paid the year of the sale, which can be a lot.
So let's say the 200,000, and let's say that mortgage is total of like 10,000 at the end of the year. They just pay off that 10,000.
What do you mean the mortgage? So
like you're seller financing it. Like, so let's say the seller or the buyer's buying it from the seller finance. And how much would the seller pay in taxes? Let's say at 200,000 is how much you're buying it for. They're going to finance it for 200,000. Let's say at the end of the year, how much would that seller owe in taxes? Just that after that 12 months.
However much the down payment was for.
Okay.
How much money they actually receive, not the interest. The interest is taxed differently. It would be if I were to, so let's say, for example, I want to buy, so let's give numbers, for example. Sorry, my dog is like snoring.
No, it's okay.
Okay. So let's say, for example, that you want to buy my house. It's going to depend on my basis. So if I depreciated all the way down, let's say my house, it doesn't matter how much I bought it for. It's what my basis is. So if 10 years ago I bought a house for 100K and I depreciated the entire thing, my basis is 0. And I'm going to sell it to you for 200. Okay?
Yeah.
I have a $200,000 gain because my basis is 0. But if you're only going to give me 20,000 now, that's what I would pay taxes on, the 20K now. Of course, you're going to pay me interest. However, there's another however. Since I have to recapture all the depreciation the first year, it makes no sense when it's a basis of 0, because I'm going to have to pay the entire depreciation recapture of $200,000 of everything that I've. So it's a lot more complicated, but it makes sense in some cases. The best way is to do a 1031 exchange.
Okay. So even if like let's say they didn't depreciate at all, they wouldn't really have any depreciation recapture. They would just pay at the end of at the year.
So if there was no depreciation, if they had like $5,000 and you paid me 20 as a down payment, they would only pay on the down payment and of course the interest that they receive.
I got you. Because I'm working with a lot of seller financing deals, like me myself buying them. So I'm trying to like figure out how to fully explain that, how their tax situation.
Yeah, I think it's a conversation for us to have probably like off, not because I don't want to bore you, but it's a lot more complicated. It depends a lot on what their basis is.
I gotcha. So let's say we're getting in 1031 exchanges. I know, let's say this person sells this property and they have $100,000. And I had the situation earlier that the person thought that he could just get that $100,000 himself and just buy it then. Can you explain like what's kind of like what you have to do with that?
Yeah. So whenever you do a 1031 exchange, you have to have a third party I can't say that word, intermediary. English is my second language. You have to have a third party hold the funds for you. So don't think that you can do it on your own. You have to have a third party and they charge. So that's just the cost of doing business.
Yeah. So you just got to do all the math for like what's better kind of situation.
Yeah, I got you. Exactly. And sometimes, go ahead.
Now, so let's say, because most of our listeners are people who are just starting out in real estate. Let's say they just got their one. What would you advise them financially to save money on their taxes? Hey, try to buy like house hack once a year. That would help save some of your W-2. What would be the best like tax strategy for someone who's just starting out in real estate?
It's hard because if you make over 150, there's no tax strategy, you know? So I would always say have a CPA who you do tax planning with, because it's going to vary by person. So make sure your records are up to date and you know how much money you're making every single month, and have a tax call with your CPA before the end of the year, not right now, before the end of the year, so you can see where you're at and what can be done to minimize that. But we can't do that if we don't have numbers. So it's hard to say do this and do that. House hack, you can house hack so that you can continue doing this every 2 years, sure. But from a tax perspective, it depends on how much money you make. Are you married? So my suggestion would be have a CPA who you do tax planning with.
Okay. I guess one of the other main questions I always have is, that's not really a question. Is someone told me one time, it probably affects you a lot. A lot of people jump from like CPA to CPA, and they have the issue is getting the new CPA. The CPA doesn't know anything the person did before that. Let's say they don't know that, you just did, you have certain amount of level of depreciation 3 years ago. They have no idea that you have that. Do you ever run into situations like that? And how do you advise people to, hey, make sure you let your CPA know all this information?
If they have a good CPA, we can work with the prior year records. Those records will give us information on depreciation. Here's what I have to say about switching CPAs. One, find a CPA not right now. Like a lot of people are like, I can't find a CPA. Yeah, obviously it's February. Like, why are you trying to find a CPA now? The best time to find a CPA, like, you know me, I'm like straight to the point. Like, people will talk bad about their CPAs and I'm like, it's probably you. Most of the time it's the client, it's not the CPA. I don't say that, but they know that's how I feel. But find a CPA in the summer. That's the best time to find one. Don't switch CPAs because they made a mistake. When I get clients who are like, my CPA made a mistake, I'm like, well, I'm not perfect. We're going to make a mistake. It's how they came up with, if they're like, sorry, they fixed the mistake, that's going to happen. You need to find someone in your niche who communicates well with you. Communication is key. So switching CPAs is just going to be a pain in the butt, but find a CPA in real estate right away. Do not go with Jenny down the block who's been doing your taxes for $100.
Yeah.
It's not going to happen. You're going to pay 10x if you want a good CPA. So that's that.
So what would be the questions they should ask to determine if that CPA is good?
Well, first, like always make sure that they know what real estate is. If they don't know what a 1031 is, I just had a call with a client who's like, yeah, my other CPA didn't even know what cost segregation was. It's okay. They're not in real estate. They shouldn't know that. So if they don't have any knowledge of real estate themselves, I would say, hey, do you know what a cost segregation is? Do you know what 1031 is? What about real estate professional status? Those are the top 3 things that your CPA should know if you're in real estate. If they don't know that, you should keep looking for someone who is in your realm. And here's a question not to ask. Here's a PSA that I tell everybody. Don't ask how much it is. Like, it's not $100. It's not going to be $100 like TurboTax is. You should think about spending between $1,500 to $2,000 when you have starting with one rental or one business.
Yeah, I have that conversation a lot. And they always ask me how much it is. My conversation is like, you're running a business, right? And let's say it's cost me $1,000. If I do the math and they save me $5,000 or $6,000 or $8,000, that's like an amazing relationship. I was like, they could charge themselves more if they're saving me hundreds of thousands of dollars.
Exactly. So if we could charge on what is it called? If I could charge my clients a percentage on how much I save them, I would only need a couple of them, but we can't ethically. But even if we don't save you money, people are always like, well, what are you going to do for me that I can't do myself? I'll be like, do you know how to do depreciation? They'll be like, no. I'm like, all right, well, there you go. Like, it's easy. Like, I mean, straight to the point. Let's not waste each other's time. So if you don't know what to do on your taxes as a real estate investor, hire someone who does. It's not going to be cheap. That's just the nature of the game.
So what about like, okay, because you don't have you can't bother your CPA all the time because it obviously gets expensive. You have them like every month. So what can they do to really help their CPA with their own tax planning by keeping books clean? And what's some things that you would love to see your clients maybe do more of, like keeping their books clean to make it easier for you?
Yeah, definitely just have good records. Use either Stessa for real estate or QuickBooks. Have good records so that we can help you do tax planning. That's the number one thing. I just nag around on that because all my clients don't have good records. It's hard. I get it. So good records is key.
Definitely when they're doing it themselves, it's kind of hard to keep it all. But how specific do you want them to get? Like, let's say like you have a certain expense, right? Like, okay, here's my expense. This is where it came from. This is what we talked about. Or like, what do you have to do?
CPAs don't need receipts. The receipts are for you in case of an audit. So you just have to be specific. All money that comes in, all money that goes out of your business needs to be recorded into an accounting software like Stessa or QuickBooks. I'm not here to audit you. We're not auditors, but in case that you get audited and the IRS says that you were having meals for $10,000, you need to come up with the receipts for the $10,000. Of course, CPAs will see, oh, you bought a Ferrari, like the example that I gave you, will question you. Yeah, that's what I was saying. And I think I have time for like one more question because I do have to get going.
Okay, no, your problem. So what would be your last piece of advice for everyone? Like if they're just starting out, going to a CPA, what would be your last piece of advice?
The last piece of advice is make sure that you do proper tax planning. That tax planning to play the IRS game should be done in the fourth quarter with your CPA to make sure that you are buying that car, buying another rental, doing cost segregation. Do not wait until the next year to try to minimize your tax because it's just not going to happen.
Yeah, because once, let's say for normal people, once January happens, you're out of luck.
Too late. Yeah, there's very, very little things that can be done for the prior year.
All right. Well, I appreciate your time and appreciate if anyone is missing this or like maybe the audio is a little bit, we're going to add that later to YouTube so everything will be good. But I appreciate your time and I appreciate you sharing your knowledge and I definitely learned a lot. So
thanks so much, Tyler. I'll talk to you soon. Thank you for having me. I really appreciate it.
Of course. You have a great day.
You too. Bye.